In this video, we are going to be actively and productively doing our depreciation. Welcome to Accounting How To. I am your host, Carolyn Grimm. That is my very active and productive sidekick, Terrence. So today we're going to be continuing on with our depreciation series as we explore another method of depreciation, and this one is called either Units of Activity or Units of Productivity. So we want to jump right into our spreadsheet and go through our sample assets to see how we depreciate using this particular method of depreciation. Okay, so we have three assets that we're using to track depreciation using units of productivity or units of activity. We have our Ford F-350, we have our Hobart mixer, and we've got our forklift. So let's jump into our units of activity, units of productivity spreadsheet and see what we're going to do with this method of depreciation. Well, this looks colorful and confusing. So here's the way we figure units of activity. We're going to take our cost minus our salvage, which we've done in other depreciation methods, and we're going to then divide it by the total units. We haven't used units up until now. Let's look at what that means. Part of what we have for each one of our assets in this example is we have units for each one of our assets. So when we set up our new asset, we said it had a cost of $24,000, useful life of 7 years, salvage value of $2,000, and we have some sort of unit that we're applying to it. So we think for our truck, we are estimating that we're going to be able to use it for 100,000 miles. So miles becomes the unit that we use in order to determine our depreciation expense. For our Hobart mixer, we're using hours as our unit, and we're thinking it's going to be 20,000 hours that we get out of this. And then for our forklift, we are also using hours, and we think we're going to get 3,000 hours out of this forklift. Because have you seen the way Terrence drives that thing? Oh. So let's jump into our first example, our Ford F-350. So we're saying 100,000 miles is the number of units that we're estimating we're going to get out of this. So in order to determine what our factor is, that we're going to multiply by our cost, here's what we're going to do. We're going to take cost minus salvage, so 24,000 minus $2,000 gives us $22,000, our depreciable base, and we're going to then divide that by our total number of units, in this case 100,000 miles. So 22,000 divided by 100,000 gives us a factor of 22 cents per mile. And then over here, we have listed out the total number of units that we actually used this asset for each year. So in year one, we used 18,000 miles. So we're going to take that actual usage and we're going to multiply it by our factor of 22 cents. It would give us depreciation for the year of $3,960. In order, of course, to stay with our matching principle, we need to do this as a monthly journal entry, an adjusting journal entry of $330. In the first year, we would be using depreciation expense of $330, accumulated depreciation of $330. And we will do that each year based on the usage of that vehicle. So the second year we used it 21,000 miles times our 22 cents per mile gives us a yearly depreciation of $4,620. And then we'll divide that by 12 in order to get our monthly depreciation adjusting journal entry. So you see here that each year we've got 15,000 year 3, 12,000, 14,000, 6,000. 16,000, and in the last year we used it 4,000 miles. Now that conveniently equaled 100,000 miles. Now the chances of that being the case, where you have exactly that number of hours, would be pretty rare. So really what's happening in that last year is we are making an adjustment to that estimate. So whatever we need to take for depreciation in that last year is what we're going to do. Because when all is said and done, where we want to end up with on the balance sheet is we want to have our cost, $24,000. We want to have accumulated depreciation that is not more or less than $22,000, leaving us with our net book value of $2,000. So we're going to adjust that amount in the final year if we need to, and chances are pretty good that we'll need to. So let's look at our Hobart mixer, and you'll see these little red spots. Warning, warning. So we've got a Hobart mixer, $5,000 cost, 5-year useful life, 0 salvage value. We think we're going to get 20,000 hours out of it. So we take our cost minus our salvage value, 5,000 minus 0 is 5,000. And then we divide that by our hours of 20,000 hours. It gives us a factor of 25 cents per hour. And then here in our usage section, we use this the first year, we used it 5,000 hours. Second year, 3,500, 7,000, 3,000, 2,000. Now, spoiler alert, that equals 20,500 hours. So we are using more hours than we estimated. So that is a red flag that we're going to need to do something different with our depreciation in that last year. But in the first year, we use 5,000 hours. That's at 25 cents per hour, gives us yearly depreciation, and that gives us a depreciation expense per month of 100. So the second year, we're going to use 3,500 hours, 25 cents per hour, 875, 73. So our usage has gone down that year. It goes up in the third year, and then comes down the next 2 years. So when we get to this last year, we need to make sure that we are not over depreciating this asset. If we did it based on our 2,000 hours at 25 cents per hour, we would end up with a total depreciation of $5,125. So what we need to do is we need to adjust that in the final year. Rather than taking $500 for depreciation in that year, we need to reduce it. So we need to reduce it so that we are not over depreciating our asset. So we would subtract that extra $125 off of our yearly depreciation of $500. So that will change our depreciation for the year, because what we want to end up with is our cost of $5,000, our accumulated depreciation of $5,000, our net book value, which represents the salvage value, of 0. If we had subtracted 5,125 here, that means we would end up with a net book value of negative $125, which is not where we want to be. So we want to be at $5,000 for our accumulated depreciation. So let's take a look at our forklift. We're going to do the same thing. We've got $8,000 cost minus our salvage value of $500 gives us $7,500. We're going to divide that by our $3,000 of hours we expect to be able to get out of this unit, and it gives us a factor of $2.50 per hour. In the first year, we used this forklift 500 hours times our factor of 2.5 per hour. So our yearly depreciation is $1,250. Our monthly depreciation is $104. Our second year, we use 600 hours, 700, 700, and the final year, we use 400 hours. Now, in this case, we estimated that we were going to use this for 3,000 hours. As it turned out, we only used it for 2,900. So now we need to adjust that estimate so that we are not under depreciating that asset. We want it to be fully depreciated at the end of the 5th year. So had we taken all of those depreciation deductions, we would have ended up with $7,250 as our accumulated depreciation, which would mean that we were not fully depreciating this asset. So we would be at $7,250 here, which would give us a net book value of $750. But our net book value should be the salvage value of $500. So what we're going to do in that final year is we're going to make an adjustment right here. We're going to increase the depreciation that we take in that year to get us to where we need to be. So the benefit with this units method of tracking depreciation is that this most closely matches the matching principle. So we are expensing exactly what we're using. So we're not doing a straight line where it doesn't matter how much we're using that asset, we're taking the same depreciation. And this is not an accelerated version where we're trying to recoup our costs up front more quickly. This is based on actual usage of that asset. So as far as the matching principle goes, this is it right here. We are directly matching our use of this asset to our depreciation expense and the revenue that we're making during that period of time. Now, the major downside of this method, you can probably already guess. Are we really going to track every hour that we use our forklift? Are we going to track every hour that we use our Hobart mixer? It would be a real pain in the neck to have to do that. But if you're looking for a depreciation method where our expenses closely match our revenue, this would be the one. So in our other videos in this playlist, we're going to look at straight line depreciation, sum of the year's digits, and double declining balance. So I'll put links to all of those in our description so that you can go through each one of those that you need to go through. So until next time, stay balanced, my friends.